All right, so Peter, what jumps out at you from this fact situation as something that we should be focusing on?
There are a lot of issues, but first, Brad, I wanted to thank you. I didn't realize you were bringing your whole extended family today, and I'm glad you had a boardroom big enough. For the people over here, I'm not intending to give you the cold shoulder. In fact, my last physical, the doctor said this side was warmer. So I'll try to include you all this. And Brad, we're going to have quite a discussion, so I did bring some vodka.
Oh, thank
There you
you.
go. I went through the fact situation. I've been involved in giving tax advice myself. I've been involved in advice regarding setting up trusts. And Section 75.2 is always a provision to be very careful about. It basically says, Brad, since you transferred property to a trust for yourself, and because you were a beneficiary, you could get that property back, a lot of bad things can happen. And sometimes we actually use 75.2 to try to turn those bad things into good things. But the courts have said, that's not really something they would support. In your situation, 75.2 was identified by Amateur as an issue, and as soon as that issue is identified, there are a lot of points that have to be acknowledged. So, one, if 75.2 applies to a trust, it means any income that's earned by that trust, income, capital gains, they're all treated as your income, even if the income was distributed to Giselle, which did happen in some scenarios. And we'll talk about the way the trust was set up as well. In addition, if 75.2 applies when property is transferred out of the trust, normally in a normal trust situation, the beneficiaries get that property on a tax-free basis. If 75.2 applies to a trust, a rollout is not available unless the property was given to you. So when Giselle was given the house that was purchased by the trust, that actually created a taxable gain to the trust, and the trust doesn't get a principal residence exemption.
So Peter, I just got this slip from the CRA, and I have this huge capital gains that I have no idea what it's about. Is that what you're talking about?
It's possibly that. It's possibly something even worse.
What's
I'm sorry to
worse?
bring you the bad news. So when you transferred the property to the trust, when it was first created, you actually were treated as selling your property to the trust. There's no roll into a trust. So when those transfers happened, there was a deemed sale. And if there were accrued gains, then you were actually personally taxable. I have issues as to whether the CRA could actually assess that tax liability now, because I don't think when you transferred that property, you knew that there could potentially be a tax bill. So I'm guessing that what you've got, I'll take a look after, it might relate to the sale of the house or the transfer of the house out to Giselle. It could unfortunately also relate to back to the early transfer in.
Okay. Well, I didn't even know about the transfer in the first place. No one told me.
I think, in terms of if that is the reason for the tax assessment, there are provisions that say the CRA is barred from assessing you if you didn't do something carelessly, negligent, or willfully. So I think in your situation, I don't think you didn't know what was happening. No one advised you to find out what was happening. You were young. I think it would be hard to say that you were careless or that you were negligent, and it certainly wasn't willful. So we'd have to debate the CRA on whether they could even issue that assessment. But if it's regarding the property that was transferred to Giselle, if it was in fact transferred, and I think that's something you guys might discuss, then there is a tax liability, unfortunately, and it's to you. Sorry, it's the trust's gain, but that gain is treated as your income, even though it wasn't your property.
Great.
So does any of this affect whether we try to bust the trust versus keep the trust alive?
I think busting the trust is something not to be entered into lightly. There are a lot of potential issues. So, rushing in to create the trust, which might have been what happened when the trust was created, that was a mistake. Rushing out of it is potentially risky as well. So some of the issues that come up with busting this trust, for example, are one, Brad, no one's looked at whether your tax status is actually one of a U.S. resident. You spend a lot of time in the States. In fact, you're there more than 183 days, it seems, or possibly. If you're there more than 183 days, you're deemed to be U.S. resident, and you're also probably still considered to be Canadian resident. We'd have to look at the treaty, in the Canada-U.S. treaty, to see actually where the tiebreaker would say you're resident. If you're resident in the U.S., the whole busting of the trust takes on a different flair. If you're resident in the U.S., all of the taxation issues regarding the trust take on a whole different flair from when you became a U.S. person. So I think we need to analyze all of those issues before we decide if busting the trust is the right thing to do. Certainly, getting your assets back or getting control of your assets, if that means maintaining the trust as it is, those I think are obviously important objectives to look at. And I think if I can just point out a few issues that, if I try not to look at these situations with the benefit of hindsight. And, there was a show my kids watched after they watched Dear Aunt Agnes. It was a show with a purple dinosaur. I think it was called Barney. In Barney, there's a song.
He's a personal friend, by the way.
Barney is a personal friend?
Yes.
Has he done something about the purple skin tone? So Barney, there was a song that everyone makes mistakes. So yes, they do. Your sister and your brother, your parents, and your mother and your father too. And that's the reality. So, accountants make mistakes, lawyers make mistakes. If there are damages, that's not something I can quantify for you, but that's something I imagine you'll look at. But there were mistakes that were made here. And first, what I think is important to look at is, could the objectives, if they were your objectives, could they have been met more easily, differently, with less negative tax implications to you? So one, to avoid that tax bill that you may have just been assessed for on the transfer into the trust, you could have lent your assets to the trust instead of transferred them. And if you lend them under the right conditions, that property is not considered to be transferred to the trust. So one, you don't have a disposition of the property, you don't have a gain. And two, you don't have a 75-2 issue unless other conditions are met because you haven't transferred property, you've loaned the property. So when Amateur acknowledged 75-2 as an issue, I think she should have, or Novice, or that both of them should have looked at this and said, okay, 75-2 is not a great thing. Are there ways around it? That, in my opinion, would have been a relatively simple way around the 75-2 problem, and it would have avoided this tax bill that you potentially what this tax bill is about. Alternatively, could a trust have been set up for Giselle that would have met the requirements we call a Henson trust, so that anything she might receive out of the trust or any income earned in the trust or the assets in the trust, the assets in the trust wouldn't be viewed to be her assets and throw her offside of her ODSP entitlement. It's something that was acknowledged when the trust was created, but it's not something that really was addressed by anyone. So a separate trust for Giselle might have been an option, and it might have given you less risk with respect to that portion of the assets put for her. And finally, any income earned in the trust, like I said, whether it was allocated to Giselle or not, because 75-2 applied, it was all treated as yours. And what's happened with the trust is unfortunately, you've got a lot of losses in the trust, right? The value's diminished. I'm sorry to, I'll tell you what you need to hear. It may not be what you want to hear, but it's, that's my view on things. So there are a lot of losses in that trust, and they are potentially an asset for you. Because if there's a way to create income in the trust, if we don't bust it, right, if we maintain the trust, you might be able to invest what you do have. You may be able to create some income in the trust and use those losses. I don't know if you'll ever use up all of the losses, but that is of value to you. So what happens with trust is if there's a loss inside the trust, it couldn't be allocated to you against your personal income. Losses are trapped in the trust. Even if 75-2 applies, 75-2 says the income of the trust is yours, the losses stay in the trust still. So there is actually a hidden asset within that trust that if you think there are ways that you can utilize that write-off over time, and even if it's not all of it, there's value to you. So I wouldn't rush into busting the trust. So the use of the assets, your U.S. aspects, and just really what it is you want out of what's left in the trust are really things to consider before you decide to formally bust the trust.
So we've heard about this notice that Brad received from CRA. To the extent that there are any other hidden landmines that we have to worry about CRA pursuing in the future, is there anything we can or should do about that at this point?
You know, it's worth looking, Brad, if the income in the trust was treated as yours in the past. I'm not sure, I don't know the answer whether I would, if the income was not treated as yours, whether you've got an obligation to go and refile prior tax returns that are not statute barred and voluntarily disclose that you had income. It's something to consider. The reason I'm saying I'm not sure about it is you didn't make the action of underreporting that income. You weren't aware of it. Now you're aware of it, and so does becoming aware of it mean that you have an obligation to go back and fix a mistake that was made when you weren't aware of it?
How would I have, or how should I have been aware of it before I just got this random slip from the CRA?
So if the trust returns were prepared, I'll say properly, because 75-2 and the allocation of income is a contentious issue with how do the trustees tell you that you've got income to report? The CRA is of the view that you fill out a trust return, you take the income that's on the trust return, and you allocate it to you just like you would if you had a mutual fund. You'd get a slip at the end of the year, a T3 slip, and would say, Brad, this is income from your trust. Technically, that's not the way the Act works, but that's the way CRA wants the allocation to be shown or the income to be shown. It's possible that those trust returns were not prepared that way. And if they weren't, you wouldn't know about the income unless you had been told about it. So I don't know, do you recall getting anything like that?
Oh, I definitely didn't get anything like that. Yeah. So do you think that's a potential claim that I would have against the accountant in respect, aside from all the other stuff that they messed up at the initiation of the trust? Is that something else that you think fell below the standard of care?
Yeah, I think that the accountants fell below the standard of care, amateur fell below the standard of care right at the beginning. And by getting you into 75-2 to start with, all of the income, the tax that might be exigible on that income that should have been allocated to you or that was treated as your income, I think you do have potential claim there depending on what tax would have been paid otherwise. And the tax on the transfer in, which could have been avoided, I think is an issue. And the tax on the transfer out to Giselle because the trust wasn't set up properly is also potentially an issue. Another example of how this could have been done, you could have avoided 75-2 with the loan. You could have avoided 75-2, and you guys could tell me, Greg, you could tell me if this would work, but if you simply gave power of attorney to your father to manage your assets, that's something you could have rescinded at any time. It wouldn't, I believe, have created a trust, and you wouldn't have had all of these issues to deal with. You would have just rescinded the power of attorney when you wanted your assets back.
So keeping in mind all of these potential failures, are there any other issues that you've missed that the accountant potentially fell below the standard of care in dealing with?
Yeah, I think the U.S. issue came up later. I think identifying the U.S. issue is very important. It's something that a lot of accountants don't ask questions when they're doing planning or when a plan's already been implemented. Whenever there's a transaction with a trustee or with any taxpayer, it's a good idea for accountants to ask, is anyone a U.S. person? 10 years ago, it may not have been a reasonable question to expect someone to ask because we didn't know as much 10 years ago about U.S. issues as we do now. But U.S. issues, in my opinion, any accountant should be aware that at least ask the question. I don't have all the answers as to what the U.S. issues are, but I know there's a problem or a potential problem. And that I think there was a shortcoming there as well, of not identifying those issues.
All right. Well, let's wrap up our meeting, and we've got other things we need to talk about.
Sounds good. Thanks.